Hi, you're listening to Cam Dadwa from the Trading Framework. This is the next installment of your training videos, and this time around I'm going to talk about auction market theory and the negotiation process. I'm going to make it very simple to understand. You can make it overly complicated, more so than it really needs to be, as I found when I first started to get into auction market theory and market profiling trading methods. Unfortunately, the historical foundational concepts when they came out from the CBOT, the Chicago Board of Trade, in their handbook, and some of the concepts that Peter Staudemeyer spoke about initially, they still apply, but unfortunately they were very difficult to understand for many people, including myself. Although I think a lot of that has to do with the fact that us as human beings, we like to overly complicate things because we think it makes it more special, which is basically very far from the truth. The things that are typically special and very worthwhile utilizing generally are very, very simple. We tend to have this idea that the more complicated something is, the more smarter it is, the more effective it is. And in trading, that's very far from the truth, because if you can simplify the method and your understanding of it, it actually makes it easier to apply more effectively. You can understand the most basic concepts of auction market theory and profiling and do much better than someone that understands many different concepts and many different ideas but doesn't really know how to put them into practice. So what I want to do is really just tell you what I believe is the most important concepts to understand from auction market theory that really should be the foundation of everything else that you do with the profiling concepts. So it's very, very simple. Please do not overcomplicate this. This is stuff that you pretty much already know. I'm pretty sure that you understand these concepts, but they have been difficult to understand because there is too much fluff around the training material that is out there, or there's just a lack of understanding of the basic concepts. Because unfortunately, with auction market theory, market profile trading, there's a lot of people out there that are just regurgitating things and not fully understanding what it means. So I'm going to explain to you the concepts that really made the biggest difference to me, and they are the concepts that I believe you really only need to understand in order to move forward with this approach. So firstly, some basics here. There are three elements of any auction. Firstly, price, which is familiar to probably every technical trader out there. It's what you see when you bring up a bar chart or a candlestick chart. It is what you see on a quote page. Basically, with the traditional technical analysis methods, we would look at price over time and we would recognize patterns. And I think that's still very applicable and something that we need to take into consideration with what we do with the trading framework. But we have to understand price in itself is just the advertisement of opportunity. It's like the scoreboard in a game of football. It's not the actual game being played, it's the end result. It's the scoreboard. It's think of price as if it's the football. It's the football that is being kicked around on the football pitch. It's not actually in itself really providing opportunity. It's about putting it into context and understanding that price is the tool. It is the advertisement that you have to analyze and put into context in order to make sense of it and actually find the opportunity. So price advertises potential opportunity at differing prices throughout the day. That's the natural process of the auction, to advertise price. Just as if you go to an art auction or a car auction, price is going to be advertised to see what level of interest there is at each price. So if there is a sustained level of interest at higher prices, the price in an auction will keep going higher for a piece of art or a car, whatever it is that's being auctioned in that auction environment. So what we find being auctioned in the trading environment, when we are trading futures markets, spot forex, or trading options or whatever it might be, we are basically looking at products that have an advertisement of potential opportunity through the price advertisements. So we must understand whether that opportunity is applicable to ourselves at any given time and if it is of interest. So it's also the fastest moving variable. So most traders that purely focus on price, especially very short term charts, find themselves typically getting caught up with noise, or typically finding themselves not really being able to move and flow with the price action itself, because it's very fast moving, especially on an intraday basis. So on an intraday basis, if you're looking at very short term charts, it can move very, very quickly, especially around numbers, etc. So it's the fastest moving variable, and it in itself is a very useful tool, but it has to be put into context. So we can begin to organize price firstly through time, and traditional technical analysis charts will look at price over time, over the process of the auction throughout the day, over the previous days, previous weeks, months, etc. So we will look at price action, what it's done previously, and we get an idea of what it's been trying to do over time, and that starts to give us more insights into areas of interest, where the market wanted to trade, where it didn't want to trade, etc. But it's very two-dimensional. So then we add volume, and not volume at each bar in the typical sense where we look at a histogram displaying the level of volume in each, say for example, 5-minute bar, 30-minute bar, daily bar. What we are looking at with auction market theory and profiling is volume at price. What level of volume is actually trading at each price? What you have to keep in mind, this is not just volume. It's actually a reflection of the level of interest that all market participants are showing at each price. And it provides many insights into the typical behavior of the market as it's been unfolding. But more importantly, it provides very useful insights, and very high probability ideas can be developed utilizing these insights as to what the market may try to do next, because that's all really we're trying to figure out. What is the market going to try to do next? So this is very, very useful when we can see price, time, and volume coming together. So auction market theory, I'm going to really simplify this, and this is all you really need to understand. The auction market theory concepts really help you understand the auctions trade facilitation process. How is this market unfolding as it auctions and advertises price higher and lower? Where is trade actually being accepted and rejected? Where is it being facilitated and not being facilitated? These are the key questions we must have. Basically, when a market starts to balance, or what we would see with price action is it basically starts to move sideways, it has began to find value, and it also is finding value. So initially, when a range starts to develop, price action basically starts to go sideways. It's the beginning of a balanced range or an area of value. So you typically see price action starting to become range bound. So that's a balanced market from the concepts of auction market theory. It means the market has an equal balance of buyers and sellers typically. Okay, I mean, it is a zero-sum game. There is always an equal amount of buyers and sellers, because for every seller that hits a bid, there's a buyer on the bid. Every time a buyer lifts the offer, there's a seller on the offer. But over time, it's the aggressiveness of the market participants willing to lift offers at higher prices or hit bids at lower prices that really define what the market actually does in the moment. But over time, if the general level of interest is to keep the market around the same prices, the market will balance, it will move sideways, and hence the reason why it doesn't look elsewhere. The great thing is the market spends a lot of time doing this, and it spends more than 90% of its time doing this. It was typically introduced in auction market theory, market profiling, that it was about 80% of the times the markets are balanced and 20% of the time imbalance. And actually what you'll find is the markets are mostly balanced, and value can be found most of the time. There are situations where you do find imbalance, but generally if you look for it, you'll find it, and it's there most of the time. It's very rare not to find a balanced phase or a sideways range. Now, these can happen in the context of trends. So that is what throws people off. But you can utilize the trends to actually trade sideways ranges and balance phases to get an idea of what direction you should focus on. So you can actually employ the value area trading methods and finding balanced markets in trending phases. There is actually really no such thing as a trending phase specifically for a market or a sideways phase itself. Usually a sideways phase is either in the context of some kind of trend, and actually within a sideways phase you'll also find trends. You'll find a trend from the low of the range. For example, from the low of the range here, you'll have a short-term trend up, you'll have a short-term trend down. Depends on the time frame. If that's a daily chart, that might be a few days up, few days down. So in a range, we typically trend, and in a trend, we range, which really throws people off when they are new to trading. And you have to understand it's all about context. There is no such thing really as a trending market, really. There's trending perspectives and there's sideways balance perspectives. It all depends on your perspective, your way of perceiving the market, what time frame you're looking at, how many days you are looking at, or how many hours of action, etc. Like, we might be sideways over the month, but you might have an intraday uptrend. Okay, so you got to take this into consideration. When a market is in balance, it is basically looking for value, and it is basically trying to find the fair prices again. When the market is balanced, it has already found value. It's already proving that the market wants to trade there, and it is trading there. So it's sideways, and typically you'll see sideways price action with a distribution on a volume profile around that range, usually somehow looking like a bell curve. It's typically a lot more distributed in the middle of the range and less distributed on the edges of the ranges. So you will sometimes find there's a little variation of that, but typically, I mean, that's the most efficient phase for a balanced market, and what I typically focus on trading around. So an imbalanced market is when we actually start to get out of that phase and we basically keep auctioning lower outside of that range or higher above that range. The trick, however, and also the obstacle for many auction market theory value traders, is that figuring out when do you trade value and when do you actually trade away from value. Now, the trading framework itself actually makes this very clear to understand, because we use Fibonacci retracement extensions to define when it is okay to trade back to value and when it is okay to trade away from value. I talked a little bit about this in the previous videos, so please refer back to those. Now, moving on, the negotiation process is very, very simple. It's basically how price is negotiated as a market auction. So it moves up in order to see if the buyers lose interest. It moves down to see if the sellers lose interest. Basically, if the market keeps moving up and the buyers keep buying, just as in a car auction or a art auction, any kind of auction, a property auction, if people are willing to keep accepting the price advertisements at higher prices, it will keep advertising higher prices, just like the market. Now, once the buyers stop showing interest at higher prices, it will stall. The market will then test around those areas, see if anybody's around. It will wait around for a little while, see if people are willing to just have a little think about it. And if they aren't there, the market will typically start selling off again, trying to see if they can find buyers at lower price. So the market actually auctions up in order to see if the buyers will keep buying, and if they don't, see if the sellers respond. And if the sellers respond, we keep moving lower, and then the market will keep selling off until the sellers are no longer willing to keep selling at lower prices, and then the buyers typically will come in because, you know, the sellers are no longer there. I mean, this is the basics, of course. So I'm oversimplifying this, but you need to understand this as a very simple process when you look at price action and charts and use auction market theory concepts with profiles. So basically, the market moves up and down to test the interest of market participants around specific prices. Then what happens as a part of this process, value is found, and this is typically where 70% of the volume is traded. There are phases sometimes where it's a little bit trending. If you use a volume profile, you might see a value area, That's not real value. Value is only found when the market is moving sideways and we are balanced. Okay, so real value, true value is only found when the market is sideways and we have fair prices to auction around. Very easy to identify, but basically the profile itself, it will define the value area high and the value area low by looking at and calculating where 70% of the volume is traded. Okay, now traditional market profile looked at time and TPOs. We don't look at that because you don't need to. It's not as effective for day trading in my opinion. It has its uses and I think it's applicable for many, but it overcomplicates the whole process. So let's keep it simple. We just look at volume at price. That's the real indication of a level of interest at that prices. So we should expect typically buyers to be interested in buying below value. So once the value area is defined, so let's say, for example, price is auctioning around a range and we have a sideways price action range. It moves up, moves down, moves up, moves down, moves up, moves down. It's not always going to just stop at the high and at the low, but this is the textbook example of this. The value area typically will be somewhere in the middle of the range and we will have a volume profile that distributes around that range and it will look something like this. As you'll notice in the previous videos that I showed, you'll see the custom profiles will define the value area. This will be the value area high. This will be the value area low. And in the middle, you'll have what we would call the VPOC, the volume point of control. That's the fairest price in the middle of the range. Generally, we want to see that in the middle of the range and then price trading around it. But we then get really good advantageous prices to sell at and buy at the bottom of the range. But there is a step to go beyond this because we have to find specific levels which we are interested in buying at and selling at, which I'll go into in the next video when I talk about composite profiling. So you just have to wait for that video to come through and it will all make sense. I talked about it again in the previous video a little bit, but I'm trying to go into certain concepts in a little bit more detail, but step by step so that you really understand it. So we should expect sellers to be interested in selling above value, buyers to be interested below value. This basically lets us specialize in doing something specific. It allows for us to be very structured with our approach as discretionary traders. Now, systematic mechanical traders have a system. Okay, that in my opinion should be traded by a robot or a system or a computer. But as discretionary traders, we still need structure. We have to make choices and decisions, but we have to make them with belief and confidence. So we do need structure so we can actually measure if we are actually trading our plan or if we are not. So we also need to understand when we should be focused on buying versus selling or selling versus buying. We shouldn't be doing both at the same time. Now, the unexpected response does happen and it will happen. Not that frequently, but it does happen. So we need to be aware of it because we need to know when to stop buying below value and selling above value. The unexpected response is basically more buying above value because it's expensive premium prices, and we wouldn't expect buyers to want to keep buying expensive prices. Just as you wouldn't expect to buy something that's worth £30,000 for £50,000 when you know it's worth £30,000. That's the ideal value. But as a seller, it's interesting. It's to you, it's applicable. It's advantageous for you to sell something that's worth £30,000 for £50,000. Of course, it's a great deal. So you're going to want to sell. Well, same thing when we get below value. Like if something's worth £30,000, but you get that offered for £10,000, of course you want to buy it. It's a great deal. But if you're a seller, you don't really want to sell it to someone for £10,000. So it's disadvantageous for you as a seller, but it's great for you as a buyer. And that's what we have to understand. This is an auction. This is a pricing for a product. We have to look at it as we are buying a product. We're buying and sell a specific product, just like you do when you go to a shop, when you go retail shopping. So you don't want to pay expensive price. You don't want to buy at you don't want to pay expensive prices, and you don't want to buy at too high a price. You want to buy at a lower price. And also, if you're the seller, you want to sell at highest prices possible, really, within reason. But at the same time, you don't want to sell at very, very low, ridiculous prices unless you really have to. So the trading framework basically helps you define what specifically needs to happen below value for long opportunities and above value for short opportunities. It's very specific, and we do go into this in a lot of detail in upcoming videos, and I talk about the specific process for moving from planning preparation to engagement scenarios and identifying specific prices to actually do business at, and then actually looking at real short-term information like order flow, how much buying and selling is actually transacting around those prices. So it gets into a lot of detail, but you have to get the basics. These are the basics. You get your head around these, and then you can move on to the next steps. So that's it for this video. I'll catch you in the next one.